Hello and welcome back to What's Next. The Volkswagen Group is in the throes of a crisis that's shaking the very foundations of one of the world's largest automotive manufacturers. This isn't just about declining sales or a tough quarter. This is a structural collapse that's been building for years. The group's inefficiency, unsustainable debt levels, and mounting competition from aggressive EV players are combining into a perfect storm. Recently, Volkswagen announced plans to shut down 3 factories, an increase from the 2 closures initially discussed. Yet analysts warn even that may not be enough. Factory utilization has plunged below 60%, a catastrophic level that makes maintaining operations almost impossible. In a nutshell, Volkswagen is running factories that are losing money every single day they remain open. A Volkswagen's debt problem, years in the making. Volkswagen's troubles didn't emerge overnight. For years, the company engaged in ambitious spending sprees, accumulating a debt load that now exceeds $190 billion. This staggering figure places it among the most indebted companies globally, with repayment due regardless of profitability. Part of the problem lies in poorly judged investment. Take their multi-billion-dollar joint venture with a struggling electric vehicle startup, a move that has yet to show any real returns. Add to this a $25 billion acquisition of a software company in China, and the pattern becomes clear. Volkswagen has begun throwing money at solutions without addressing the core inefficiencies plaguing its operations. Meanwhile, the group has entered joint ventures with numerous companies across China, including partnerships with XPeng and Sync. These initiatives were meant to secure a foothold in the competitive Chinese EV market, but they mostly added to the group's financial strain. And then there's the debacle of Volkswagen's internal software development program. Initially touted as the company's answer to Tesla's technological edge, the program has been an expensive failure, with billions sunk into the project that yielded little progress. Volkswagen is now left playing catch-up to rivals in an industry where software is becoming as crucial as the engines themselves, collapsing profits and mounting losses. The financial fallout has been brutal. Profits across Volkswagen's major brands have nosedived, with declines steeping as 42% reported for some divisions, such as Porsche. Overall, the group's profits have followed a similar downward trajectory, leaving its leadership scrambling to reassure investors. One glaring issue is Volkswagen's refusal to adjust its dividend policy. Despite the financial struggles, executives continue to prioritize shareholder payouts, maintaining a minimum payout ratio of 30%. This has created a rift between leadership and workers. Employees argue that if sacrifices are to be made, they should start at the top. Why, they ask, should they accept pay cuts while executives and shareholders pocket millions in dividends? The company's leadership, however, insists that dividends will naturally shrink as earnings decline, a position that has done little to ease tensions within the workforce. The reality is that maintaining such payouts while the company bleeds money only exacerbates its precarious financial situation. The factory utilization crisis. At the heart of the Volkswagen troubles lies the issue of factory utilization. Across its German manufacturing network, plants are operating at less than 60% capacity. To put this into perspective, a well-run factory should ideally operate at 80 to 90% capacity to maximize efficiency and profitability. Anything below that threshold means that the facility is running at a loss. Volkswagen's situation is far worse. With unused capacity estimated at around 800,000 vehicles, the group is essentially paying for factories to sit idle. The costs are staggering. Fixed expenses such as labor, energy, and maintenance remain constant regardless of production levels. When production declines, these costs don't just stay the same, they become disproportionately high relative to revenue. This inefficiency is compounded by the fact that most of Volkswagen's factories are located in Germany, where labor and energy costs are among the highest in Europe. It's a recipe for financial disaster. The leadership has acknowledged that maintaining the current setup is impossible, yet they face fierce resistance from unions who refuse to accept closures or wage cuts, union resistance, and strikes. The unions are not taking Volkswagen's cost-cutting plans laying down. Workers' strikes have already disrupted production, with employees staging walkouts across multiple sites. These strikes, organized by Germany's powerful IG Metall union, are only expected to escalate. The union's demands are simple: no factory closures and no wage cuts. For Volkswagen, this is a catch-22. The company argues that closures and cost reductions are necessary to remain competitive in an increasingly hostile market. Yet without the cooperation of the unions, implementing these changes becomes nearly impossible. The strikes themselves are adding to Volkswagen's inefficiency, further reducing production at a time when the company can least afford it. Unions have also criticized the leadership for its tone-deaf approach to communication. In a recent speech, an executive wished employees a Merry Christmas while simultaneously hinting at layoffs and pay cuts. This move, described by union representatives as mockery, has only deepened the divide between workers and management. A shrinking market and growing competition. Beyond its internal challenges, Volkswagen faces an increasingly tough external environment. The European car market, once a stronghold for the group, is shrinking. And meanwhile, competition is intensifying, particularly from Chinese automaker brands like BYD, XPeng, and NIO are entering the European market with affordable, high-tech EVs that threaten Volkswagen's dominance. Chinese manufacturers have several advantages. They benefit from lower production costs and government support, allowing them to price their vehicles aggressively. Moreover, many of these brands are at the forefront of EV innovation, offering features and technology that rival or even surpass what Volkswagen currently offers. Volkswagen's response has been to double down in its EV strategy, but progress has been slow. The group's flagship EV platform has faced delays and technical issues, putting it at a disadvantage in a market where speed and adaptability are key. Leadership under scrutiny. The crisis has placed Volkswagen's leadership under intense scrutiny. Workers and analysts alike have questioned the group's strategic decisions, particularly its reluctance to scale back executive pay or dividends in the face of mounting losses. The conflict between management and workers underscores a deeper issue, a disconnect between the priorities of those at the top and the realities faced by employees on the ground. This divide is emblematic of a broader challenge within the company, a lack of cohesive strategy and unified direction. Volkswagen faces a precarious path forward, with each potential solution fraught with challenges. The company's first option, closing more factories, would directly tackle the issue of underutilization, a major drain on resources. Shuttering plants would reduce fixed costs like labor and energy, while enabling Volkswagen to consolidate production into more efficient facilities. However, this move would face fierce opposition from unions, whose strikes have already crippled operations. Closing factories could further sour labor relations, escalating disputes and potentially delaying any financial recovery. The broader implications, including job losses and social backlash within Germany, where many plants are located, make this a politically sensitive route. Alternatively, Volkswagen could attempt to renegotiate labor agreements. This could involve seeking wage freezes, reduction in overtime, or restricting benefits to lower costs. While this approach avoids the immediate fallout of layoffs, it would require significant concessions from unions, which seems unlikely given their current resistance. Strikes and walkouts have already demonstrated the union's willingness to fight against perceived threats to workers' livelihoods. The most critical and complex challenge is addressing Volkswagen's $190 billion debt. Asset sales could provide some relief, such as divesting underperforming units or scaling back unprofitable ventures. However, finding buyers for these assets in a highly competitive market could prove difficult. Cost-cutting and increasing operational efficiency are vital but time-consuming measures. Success will demand bold leadership, meticulous planning, and a delicate balancing act between financial necessity and maintaining employee and stakeholder trust. A warning for the industry. Volkswagen struggles are a stark reminder of the challenges facing legacy automakers in the modern era. The shift to EVs has upended traditional business models, and companies that fail to adapt risk being left behind. For Volkswagen, the stakes couldn't be higher. The group's survival depends on its ability to navigate this crisis while preparing for an increasingly competitive future. Whether it succeeds or becomes a cautionary tale remains to be seen. In the meantime, one thing is clear: Volkswagen's days of business as usual are over. The group must reinvent itself or risk losing its place at the table entirely.